going to talk for a bit without looking at the charts to begin with, because there's a very good book which I read years ago called 45 Years of Stock Market Operating. And I've always wanted to write one, 50 Years of Stock Market Operating. And as I started in 1966, I'm nearly there. So you just have to wait a tiny bit longer for the book. There's another very good book called Where Are the Customers' Yachts? If you win in the stock market, you get a yacht. And I do have a very nice yacht. So some of what I'm going to tell you might be worth paying attention to if you want a yacht too. Before going to university, I became a mechanical engineer, and this is relevant when I'm making technical analysis. I worked for a company called Lucas, who used to make headlights and all that sort of thing in Birmingham. And they taught me how to go onto the production line and set a lathe and a milling machine, automatic. In those days they weren't computer controlled. You were given a box of gear wheels and cans to set it to make whatever the component was going to be. But what you learned is because they were mechanical systems, after a few hours of running, the machine would get a little bit out. It might overheat, or it might just simply, a cog would jam or something. So what you did was you didn't measure every bolt. You measured every 1,000th bolt with a micrometer screw gauge, and as long as they were all within certain tolerances of where they should have been, you let them go through. But as soon as the machine was beyond those tolerances, you stopped it and reset it. And this is relevant because what we're actually doing is something called regression analysis. And this became relevant later. Anyway, as soon as I qualified as a mechanical engineer, I realized I didn't want to actually be a mechanical engineer. And I went to the university and read economics with statistics as the subsidiary subject. And when I then left the university, I went to Phillips and Drew in 1966, and at that time that firm was rated #1 for fundamental research in the City of London. It had a significant number of all of the actuaries in London in the firm. And what got me in is, I think to become an actuary took 14 papers, and my degree course exempted me from 9 of them, so I was nearly there. I never actually took the rest. You had to say that you would be willing to take the rest, then you got the job. And I stayed there and thoroughly enjoyed it, but of course you had to read a book by Benjamin Graham, and it's the follow-up by Graham Cotterell. So you learn something called fundamental analysis. But my job is to sit on the sales desk and talk to institutions. All of my clients, most of my career were institutional clients, not private clients. And I realized fairly quickly that there were 2 sets of stocks. There were the ones that the fundamental analysts who were very cheap, very good companies, and then the ones that were going up in price, so they weren't the same at all. So we better know about why they were going up in price. And one of my clients, the Guardian, met me in a pub in Gould's Brothers of Gutter Lane, actually, and produced a little chart for me to say this is how we know when they're going up or down. And it was a point and figure chart of the FT 30 share index. They hadn't invented FTSE back then, and you had to do it by hand. And I stuck his little piece of paper in the back of my diary and kept it up to date, and it did indeed help me make some calls on the market for the clients. And then I got to the end of the piece of paper, and I had to decide where to stick the new piece of paper. If we'd been coming up, because I'd stick it on the top corner, if we'd been going down, I got stuck it on the bottom corner, and came up very quickly with my first law, which is called the new sheet of paper theory, or the transpapal mutation theory. And it goes, wherever you put the new piece of paper will be wrong. It would reverse almost immediately. And at this stage, I had no interest in being a technical analyst. But I did have to comment on all British stocks, of course, in the British market. And as I was a partner, I demanded a computer. They gave me one. In those days, it didn't fit into your briefcase. It was a bloody great thing, the size of an electric typewriter. A little tiny screen about the size of a postcard on the top of it, a Hewlett Packard. And I would laboriously enter prices in there, and then the computer would plot me my charts. And this was better than my handwritten chart, because like my handwriting, I often can't read even though I plotted the chart. Anyway, I then did what came naturally to me. I would put a trend down the middle of the plots of the prices, because that was regression analysis, and I put in 2 parallel lines, 1 and 2 standard deviations either side of that trend. And I suddenly got a phone call from somebody called Alec Ellinger, who I'd never heard of at the time, but it turned out he was a doyen of something called technical analysis. And he said, we run conferences here in Cambridge and we call ourselves chartists. And what we do is we get a ruler out and we connect all the highs or all the lows. We think your idea of putting a trend line down the middle is frightfully cool. Why don't you come and tell us why you do it and how you do it? So for years I had to write about what regression analysis was and all of that. I think Mr. Bollinger was born at this stage, but he was in short trousers still at school. So this is where we are in time. And most charts were plotted by hand. And in this country, there were only two services where you could buy paper charts, very good ones. One came from Alec Ellinger's company called Investment Research at Cambridge. And they indeed had a room full of ladies with mapping pens doing very, very neat charts, British stocks. And if you ordered them, they'd come down by express mail and get it the next day. And the other one was a company called Chart Analysis, where they did point and figure charts. And I met the man that owned that company called Teddy Clark. And he told me one day, I'm bringing over a young, bright young man from America. And that bright young man's name was David Fuller. And I met him quite early on. And he used to, in a building not far from here, what's called Winchester House, doesn't exist anymore. In the basement of that, he would do lunchtime presentations. And I got the idea, this is making a hell of a lot of sense to me. And he's using some things called indicators. We'll have a few of those. But he was still using point and figure charts, and I'd moved away from the point and figure chart onto the time series chart, because I think in terms of time, anyway, I like the computer. And then a bit after that, there's actually Data Stream, which is now part of Reuters, but it originally was part of the research department from Hawker Vet, the firm of stockbrokers. Their Data Stream, they'd allow it to draw charts of almost anything you wanted. And that, to me, said, okay, I'm going to stay in this industry. The machine can draw the charts much neater than me. I can now cover a large number of things very quickly. And now, of course, you've got a wide variety of products like this company's, and you've also got Bloomberg and lots of things. And the power of a computer is so fantastic these days. You can let the machine do some of the work, because you can write an algorithm for almost everything you're looking at on a chart. So let the machine do, that's what machines do well. You can feed it an awful lot of data. It can scan through universes and throw out ideas for you. The final decision is yours, of course. You take the responsibility and then the machine give the order. At least I would. Anyway, along the road, back in 1998, there were three big societies of technical analysts. One was the MTA, of which you were a chapter. The other one was the STA, which is in Britain, and I happened at the time to be the chairman of it. And the third one was in Japan, in Nippon Technical Analysts Association. And there was a meeting there, should there be a global coordinating body called IFTA? And if there was, how would we get it together? And it was decided there should be a body called IFTA, which is the International Confederation of Technical Analysts, and and the first chairman would be Ralph Akampora. How are we going to pay for it? And that's when I put my hand into the air and said, we'll run a conference in London, and if you all come and support it, of course it'll make a profit, and we'll donate the profit to IFTA to get you going. And actually it made one of the, because we were lucky, if you like, it made a huge profit, which got set IFTA up, and it's never looked back since. I think this is the 26th year of IFTA now. I was the next chairman after Ralph, and I'd just come back from San Francisco to the latest IFTA conference, and there were 5 old fogey past presidents like me there, along with the new ones as well. And it was rather amusing because all of the young technicians at that conference were bullish to a man and woman, and all of the old farts were extremely cautious and bearish. That included me, for reasons I'll come on to in a minute. The second thing that this is very relevant is there are 2 ways of using technical analysis. One of them is trading, which I think you're probably more interested in. But to be honest, my job was originally never trading. You trade for yourself, but the job was to go and see all the big institutions, and quite frankly, big institutions can't trade. BlackRock manages $4 trillion. Trading, you can't trade $4 trillion. But even back in the 60s, the biggest clients in England were the Post Office Pension Plan and the Pru. And Ron Artis, who then ran the Pru, said, we seem to have underperformed the market. I asked my chaps why, and he told me, you've got the wrong stocks. And his question was, how can you have 1,500 wrong stocks? So obviously you can't, it's the weight of the money in the wrong asset classes. And at that level, they realize it's cheaper to be index linked. And then the big decision is the weight that you put into bonds or property or equities, and indeed which country you put them in. And there were plenty, back then, there were plenty of countries whose indices were not correlated to each other. So by going to different countries, you could spread risk. Increasingly, you can't do that. We lived in two joined up a world now. But at that time also, people who went to business school and even economics were taught something called the efficient market hypothesis. They'd read Malkiel's book, A Random Walk Down Wall Street. And if you said you were a technical analyst, they said, oh, you're the sort of chaps who look at tea leaves. How pathetic. Everybody knows that doesn't work. Because nowadays we've moved on a bit and the random walk theory is wholly discredited theory. Poor old Eugene Farmer must be suffering, and you can see the rate at which money is walking out of Vanguard and other funds that operate in that way. But you'll still find an awful lot of kickback from people who perhaps aren't terribly well briefed. We're still sort of Cinderella, you know, we're not the big sister, we're the little one that might get left behind. We're going to end up in the coach with the prince, but yet we are the Cinderella of the investment fraternity still. So you do have to be very clear in your mind, have answers for your own confidence to carry on acting, why it isn't an efficient or random walk. Firstly, the major premise of the random walk theory is all human beings are perfectly rational and perfectly well informed and always act consistently in their own best interests. Whereas Nobel Prize winners like Harman and Tversky, have come up with things that there are no human beings like that on this planet. Human beings fall in love with themselves and out of love and with their stocks and investment, and they do totally dumb and stupid things. And when you put them through a crowd, it becomes even more ridiculous. Actually, one of the first books I should have recommended and was recommended to me is called Extraordinary Popular Delusions and the Madness of Crowds by Mackay. It was written 100 years ago or so, a little tiny thin book, begins with tulip mania and brings you up to date from there. It's absolutely vital because it's just how markets move. You'll also need to know statistically, and I haven't brought them today, but I have some really neat slides that show this. You can reduce it to the level of a party game. I'm going to show you 4 squiggly lines. Can you pick the odd one out? And your dog or your child can do this. The odd one out is always the random walk. If you plot the returns around the mean of real markets, you are told that they will fall into normal or Gaussian distribution. And then when you plot a random walk that does indeed fall into Gaussian distribution and put them side by side, you'll notice that the real world market is very spiky, and it doesn't all stay in 2 standard deviations. You get 7 and 5 and 10, 7 standard deviation spikes regularly, far more often than laws of chance allow. And that's where the money is, of course. That's where we make our money, on trends that do that. So in words, in the real world markets, trends appear and persist more frequently. They stay for longer than the laws of chance allow. You do have to be careful though, because as Nicholas Taleb points out in his books, Surprised by Randomness, Black Swan, and his latest one is Anti-Fragility, points out random walks can produce a trend. It happens. It doesn't happen as often as real markets do though, so that's the trick. So it's all about identifying a trend, getting in and getting out. Now, I pointed out that a lot of clients don't trade because they're just too darn big to trade. I mean, even coming down to smaller than some of those giants. When, for example, Anthony Bolton, who picked his stocks fundamentally, but always used charts, he actually spoke to the Technical Analyst Societies on several occasions before he retired. It would take him months to get into some of his positions and months to get back out. So trading in the sense that we would talk about it wasn't what he was doing. But he would still use the chart to know if the trend was up and to know where the levels of support and resistance are. Because if he was a buyer, he kind of wanted the stock that was at the support level, or rather at the resistance level. He's perfectly prepared to take it out. He needed to know what I have to pay to get that amount of stock on board. So it is useful even for giant investors. But what the giant investors wanted me to do when I was at HSBC was to give them scenarios of how the world was unfolding and where we were in that world. And when we come to these slides here, that's what I always used to do. So my scenario was always called mapping the markets. But most people are interested in trading. And at the IFTA conference in San Francisco, more than half the audience there were interested in trading, and some of the biggest traders on the planet were there. Names like Ed Sikota, who's been clocking up his equity curve at almost 60% for many years, were there. And when asked to explain his rules, he said it will take about 3 minutes. It's as simple as that. And then he spent the rest of the time telling you how to actually obey those simple rules. And he actually appeared with a banjo, and he sang his simple rules. And all of the great traders, basically their rules fall into the same category. You're going to identify a trend. You're going to get whipsawed some of the time, so you will expect to make losses at the beginning and the end. But one good trend, when you capture it, will pay for all those losses. And when you are wrong, you're not going to buy more because it's not cheaper than it was before, as the fundamental analyst would tell you. You're going to cut it because you're simply wrong. And you're going to, more importantly, control your risk. The absolute vital thing was position size. It isn't actually, don't burn the midnight oil too fiercely on how to get into your trade. I've actually seen a very good exercise done on entering trades in indices on a totally random basis. But if you manage the trade correctly, you can still come out a winner. Secondly, you can have a trading system set up with far more losses than wins, but the losses are all little ones and the wins are all big ones, and they often make more money than the trading system set up with hardly ever gets it wrong, but then you don't capture as much. To give you an idea, if you were to wait for an index to rise through its 1 year moving average, you wouldn't be whipsawed very often, but you'll miss an awful lot of the bottom of the bull market. And if you wait for it to cut downwards through its 1 year moving average before you decide the bull is over, you'll give back a hell of a lot at the top. So that would be an almost faultless system, actually. Hardly ever get whipsawed using a 1 year moving average, but you don't make as much money as someone who gets in and is wrong occasionally at the bottom, but he takes more of the ride when he does it. The more conventional 200-day moving average is better. It gets whipsawed more often, but not that often. Another point that comes out from this is it's very naive to expect one single trading strategy to work all of the time in all markets. So you're probably going to need, playing around with your terminal, to develop several little strategies and to know when to put them on and off. And if you think about it, when the market is turning into a new bull market, a certain set of circumstances are going on there. Sentiment will be absolutely horrendous. Bear markets always bottom in total gloom and capitulation. As they start to rise, they rise through cynicism and disbelief, a wall of worry. By the time they're gaining confidence, you're nowhere near the bottom. And when people tell you, as they're telling you now, yeah, get a really good recovery here, what could possibly go wrong, you should be beginning to worry about it, because it gets quite scary at that point. As Warren Buffett points out, you should be brave when everyone else is frightened, and you should be frightened when everyone else is brave. And I detect far too much bravery around the place just at the moment. And I'll come on to what I don't like about it in a minute. But secondly, once the bull market has got going on some real upward momentum, you can trade it. In fact, it's very difficult to beat a buy and hold strategy. But somewhere in the middle of the bull market, you will become still in a bull, still very strong, but actually way too high too soon, it's overbought. And you will need a little strategy to capture a pullback. Obviously, the golden rule is never trade against the main trend. But even if you don't go short for the pullback, you might well reduce your long position. And then when you're in a topping market, you have a different thing, and the same applies down a bear market. When you're trading for a rally in a bear market, you might just want to close a short rather than open a long. Now, what you therefore need is a very big picture way of going through the markets, and at a glance you want to know, is this a buy strategy or a sell strategy? And at a glance is, as we know in Japanese, the word is ichimoku. That's what it means in English, at a glance. So a very neat way of dividing the world into, these are potential buys and those are potential bulls, is are they above the cloud or below the cloud on an Ichimoku chart? So have those, they're on most terminals or many terminals. I'm not sure if they're on this system yet, but I expect they would be. And when you then get halfway up a bull market, you don't know it's halfway up. All you know is it's gone too far too fast, it's massively overbought. The various RSIs and things are telling you it's overbought. You want something that might accurately capture that exhaustion move temporally. And again, there's very little better than the temps de marque indicators. If you go through life counting up, I don't know what's happening now, 12s and 9s and 13s on your temps de marque, you'll find in plenty of market conditions they don't work. But because they're not designed to work all of the time. But when you have had a very exhaustive run, that's precisely when they're designed to work. And they very often capture the top tick of the move. So you get yourself in on an Ichimoku, it's above the cloud. You haven't hit the bottom because it takes a bit of a move to get there. Then you can switch to a de Marque model when the thing's massively overbought. If it's not massively overbought, you just stay long. And then when you're near the top, very often you're going to get a rolling distribution period at the top. So it take a long time for the whole market to top. So you'll need a breadth indicator. This is exactly what's happening in Wall Street at the moment. All of the really big stocks, the good guys with names like Walmart and IBM, their share price has been going nowhere for months. They've just had terrible figures. If you need, somebody might need to hit some button here to make it come back up again. No signal, so. Oh, here, yes. So you need a different set of signals. And breadth would do this, because what happens is the jumps, the generals, if you like, stop moving. Now in America, the original general was General Motors. It was the world's biggest company. As that went bust, for a while afterwards, under Welch, it would have been General Electric. But now the generals are things like IBM, Walmart. If ever there is a backbone to the American economy, it's these. Their figures are rubbish, their charts look toppy. So what happens is fewer and fewer stocks carry on holding the market up. And are they cheap, Warren Buffett style? Well, frankly, they haven't got earnings at all. They have names like Tesla, Netflix, etc. And this is always what happens. So when you get to this position, these things can indeed take the index up higher. But it's a sign that there isn't any breadth there. You've got distribution. Under normal circumstances, you would get a major pullback. I have to say that at the moment, because of quantitative easing, we're not living in normal times. And depending on what the Fed continue to do, or even if they change it, that can override some of these things. So you need to switch from model to model to model. And you probably need about 6 models, basically. Basically, up, steeply up, down, steeply down, sideways, and then not a trading range, but a pullback within a steep trend, either way. Those I would have models for those, and I think something like Ichimoku with de Marque, or at least 2. With the other ones, there are loads of different indicators that can build you models, and you can back test them on these machines really very quickly and very easily. And then you have to stick to your rules, because even in a perfect world, you can still have a run against you. If you don't set up your trading system so that you can be wrong 20 times in a row and not get wiped out, you will get wiped out. So this is where position sizing comes in. On your back testing, you work out what is the probability of the risk to reward of this. Obviously, when you put a position on, your first risk is the money you put into the market, and the gap between your entry price and your stop loss level. There will always be stop loss levels which you could pick, and again, some people can take more risk than others or tolerate it. So that's your risk. And what you think, you don't think in terms of a unit of money, you think in terms of a unit of risk. If you think about it, if you were to put, say, I'm having 10 holdings, I'll put 10 of my money into each position, but long before you're wrong 5 times in a row, you would have given up, terrified, with your tail between your legs, you won't be able to carry on. You certainly won't go 10 times, you'll be completely wiped out. So you need to set it. Basically, if you put 1% into each trade, you can be wrong 10 times in a row, and then when the bet pays off massively, you're still back in the game. So and you should measure your success or failure by how many times your unit of risk is. That if the portfolio is small, it'll be a small sum of money, but for you, it's 1 unit of risk. And I suggest it probably shouldn't on any individual trade be more than 1%. Otherwise, in volatile markets like we've got, you're very likely to not last long. But even if you do last quite a long time, the way markets change over time, one of those days you will have a run of 10 against you. And the secret of some of these giant traders is they have the bottle, if you like, to politely put it, to hang in there, backing their system when they've been wrong 5 times in a row, knowing that one big trend when they capture it will pay off for 10 whipsaws without any problem. But training themselves, most of the books that people like Ed Wright or this guy, Van Tharp's another one, when you go on their courses, it's not about stocks and prices, it's all about you. And it ends up a little bit like Buddhist philosophy. How can you calm yourself down and have the confidence to know that you're going to be okay in the end? Because I can tell you your emotions will boil fairly fast. It's different when you're dealing with somebody else's money. I'm always amazingly brave with other people's money, but with your own, you watch it like a hawk. And you have to find that level that your nerves can take. And so I think basically when you're going to trade, there are 2 giant rules that must never be disobeyed. You never ever make a forecast, not under any circumstances. You don't know what the future holds, but you do know that today's setup in the market on your system gives you a probability of a profit 3 times bigger than what you're risking, or maybe more than that. But you never take the risk if it's a worse bet than 3 to 1 in your favor. And then when you put the thing on, you have a stop loss if you're wrong, and you see what the market's going to give you. You don't predict it's going to give you 3 times your stake. You know from experience there is a probability of that. But if you think about probabilities, each individual trade is 100% right or 100% wrong. It's only in a distribution of lots of such trades that you can say, well, it's got a 60 to 80% probability coming out. You don't know each time which one it is, so you back them all, and you keep backing them all even when several of them go against you. And that's when you do need to be very inner calm. Know that you can survive this. You know, go and have a stiff drink, but just carry on, basically. And this is what the great traders have got. Some of them can withstand monster drawdowns. And I have to say, if you were in a big bank doing it, you'd be fine. But you're doing it with yourself, you can hang in there and you can do very well. But the last bit that many of these traders have is they don't attempt to cover the whole world. They pick 1 or 2 things, or possibly a small group of things, that they know a lot about, and they just trade that. This Ed guy trades basically wheat and corn. That's enough. Somebody else I met only trades oil, nothing else. So they might have 100 separate trades, each of 1% of their capital in oil, put on at different levels and things. And they treat each trade separately. So there's only one instrument. So they're taking the instrument that the risk they're taking is if that one thing goes completely belly up and they're still in it, well then that's a damage to them. But they actually are handling their risk by incremental trades. So the first rule is don't make a prediction. The second rule is always be incremental. I think 1% is probably as big an increment as you should ever go. Otherwise, you won't be in the game for long. Now, if I move on, though, to what my job always was, it had nothing to do with that, because, as I say, the clients were always too vast to be interested. They want to hear, how does the world look, and what our strategy should be using your technical analysis. And this is where my economics came in, and the mapping the markets. What I spent my life saying is, if Joseph Schumpeter, the economist, was right about the various economic cycles that he saw working in the world, then I can show you, I draw a map of what the stock market ought to do and show you where we are on the map. And economists know, so I actually wrote a piece years ago arguing that if you were in a bull market, starting with very few number of buyers who were fairly cautious. By the time you got up to the top of the bull market, you had loads of buyers, all of whom were very aggressive. This process of unwinding of buyers and sellers would generate a special shape for a bull market and a different special shape for a bear market. And I put this in my newsletter, which I wrote at the time, which was called The Amateur Chartist. And I lettered it ABC all the way up. And then immediately my phone started ringing, "You've lettered the waves wrong." And I go, "What do you mean they're my waves? I'll put letters where I bloody well want to put them." He said, "Well, Robert Proctor says it's a 1, not an A." So of course I then was compelled to find out who the hell Robert Proctor was and what the Elliott wave was all about. And as it happened, I had a flat in the Barbican, and in the next door building was somebody called Bob Beckman, who's dead now, bless him, but he wrote a very good book actually on the Elliott wave too, so I would meet him for dinner. He was married to a lady called Penny, and at the time I started the meeting he was on his own, so the joke was Bob was penniless. Anyway, we discussed the Elliott wave, and I decided that although the shape of the Elliott wave was fairly similar to mine, I didn't like the Elliott wave forecast. I was going to stick to my waves and carry on lettering them my way. But there is a definite similarity between what you get. But I didn't fit the waves to it the way the Elliott wave guys do. Either the moving averages, moving away from it back to the 200-day line, made this shape, or they didn't. And if they didn't, there had to be a reason why, and I would find what that reason was. But you always expect in a bear market to get a fall, followed by a rally, followed by the rest of the fall. And actually a bull market tends to be a 5-legged thing, with usually the middle leg is the big one. But there's most euphoria at the top, so you can have in a bubble market, the last leg's the really big one. So if you need to know if you're only in a bubble or only in an ordinary bull market, then you can make a prediction there. So my job was always to make predictions for great big institutions to then invest on the back end. And in Schumpeter's model, there are 3 lengths of cycle. The very long-term one is called the Kondratiev wave. And Mr. Kondratiev thought it was about 52 years long, but he said in his own writing it can vary an awful lot. It's almost like a whole investment cycle. And then around that, there's a much more regular cycle, the Decadian rhythm, called the Jugglar wave, after Clement Juggler, who wrote it up. And you can backtest this. You look at most stock markets, there's an actual a regularity to what they do in each year of the decade. And that's relevant right now, because what they normally do in this year is drop. In the early years of the decade, the market is normally flat to negative, ending with a low, usually late in the 3rd year of the decade. The 4th, 5th, and 6th year of most decades is very bullish indeed. And then there's normally a very nasty correction. On average, it's in the 7th year of the decade. But in '98, it was in the 8th year. And last time around, 2007 into 2008 was the leading thing. You can take that way back, you'll find this cycles, and then you end the decade coming back up again. But this Decadian rhythm is itself superimposed on that secular trend. And the rule of charts is the longer the term trend, the more the long-term dominates. Coming back down again, now after the 10-year cycle, there's a 4-year cycle called the Kitchin wave, K-I-T-C-H-I-N, economist he was. Back in the days when Britain was the dominant superpower, it was our cycle, and it started in the Industrial Revolution. And under British rule, it varied really quite a lot. One cycle might be 3 years, the next one 5, but on average it worked out at just over 4 years. Ever since 1946, when of course America was obviously the dominant superpower, it became the presidential election cycle and is mandated at 4 years. And what normally happens is you get, because of the hype, a run-up to and indeed through a presidential election. It doesn't matter who wins, even if he's got a W in his name, it's still bullish for the market. And then the next year you get a nasty reality attack, and then from the cheap level you start going back up again, ready for the next election. You've got a lame duck president, by the way, right now. He can't stand again. He can't do most of the things he wants. He just won a battle, but you know, this is where we are in that cycle. And then the last cycle, which is very regular and backtests fairly reliably, is the annual seasonality. And again, probably because of the British Empire, it is the world's seasonality. all markets, North or Southern Hemisphere, have the same damn seasonality. And in words you say, sell in May and go away, come back in late October. And if you're going to get a crash, you have to bet in advance when will the crash be. It's nearly always late October. Sometimes it's November. You don't have to have a crash, of course. Now, when you eyeball a chart, you often can't see the seasonality because it's superimposed around longer-term charts. So if you're in a roaring runaway bull market, the seasonal weakness just means it isn't as strong as it was in the good part of the year. But it may not have escaped your notice that May has been top for most indices so far this year, and until quite recently was even for the S&P. Incidentally, Britain and Germany are nearly at their highs. The only market that's really above its high now is America. So the rule is all Western world markets are lower now than they were 12 years ago. And although the S&P is higher, it's actually still trapped into an expanding top, a broadening top pattern of almost classic shape. So it's not free yet. Tom DeMark's just put out a slide on his page on Bloomberg overlaying the Dow Jones on 1929. The prediction is one more flip up and crash, or at the very least a nasty correction. When you're making predictions, I would make predictions like this. The economic cycles also argue for this pullback. Now here's the thing. If, because QE just keeps pumping money into the market, you don't get your pullback now, unfortunately it means you don't get your run to 14, 15 and 16. It's like winding a spring. You have to cross the spring down before it can spring back up. If you don't start a new bull market from a high. And again, looking at the 4-year cycle, on average, it is about 48 months long, and typically you get 3 good years and 1 nasty correction year. The nasty correction normally fits into 9 months, but occasionally they're stretched longer. Well, this bull market itself is already virtually 5 years long. It's only got a few more months to do it. So far what has happened is the QE has been overriding the shorter term trends. We don't yet know if it's going to override the 10-year one as well. Why it might not is even though they just shoehorned Janet Yellen into the Fed, and she won't change policies this side of April, the fact is there are various other people at the Fed who've written policy statements on why QE hasn't done what they hoped, it isn't really working, there's no actual point in doing anymore. The only reason for not cancelling it now is that they found out if we even mention we might like to ease off on it, the markets will panic, and they know that. They don't want the markets to panic. That's what it's all about. It's how to scam the markets. So let's move on to this. Yes. There we are. This is the FTSE market. On the long-term chart, I think you can see the first high is the year 2000. And we were in the old, what I call the old normal, up until the year 2000. What is the old normal? The Western world is the dominant power. It used to be Britain, now it's America. But the Western guy's way of doing things is what works. We're now in a transition period, a secular trend. If you stay lower than you were after 12 years ago, you're definitely in a secular downtrend. And by the way, secular downtrends don't stop at 12 years. 18 is about as short as they're ever likely to be, and it can be longer than that. So significantly taking out the 2000 high, except in markets which are going to rig with $3.6 trillion worth of QE, most other markets aren't going to take out their high of 12 years ago at any stage in the next 5 or 6 years. On the contrary, they're going to fall back into this. You can see it's in a trading range, a very wide, broad trading range. The current rising trend, we're still above the red line, which is the 200-day line. So if you say, are the traffic lights at red or green at the moment, they're still at green. But I pointed out with the lack of breadth on these things, that it's getting dangerously near a top. Sentiment is way too bullish. The stocks holding the market up are too lightweight and spivvy. The real ones are giving you the real message. And as it happens, Britain is one of the best markets, but relative to the other Western world markets, the real winner is Germany. It's the most awesome production economy on the planet. America used to be that, but it's not now. I'll come on to America in just a second, but in fact Britain is relatively good, which is why we've bounced back to virtually the old all-time high. And in my opinion, we will not take out that all-time high before we cut down through the red line and have a significant pullback. And the ingredients for, if you fall, as happened in 1987, 22% in a day, that can happen. It's called a crash. It's not called a bear market. It has to follow through progressively after that to be a fully fledged bear market. But you can certainly crash. There are plenty of stocks that are more overbought than that. They wouldn't even reach their 200-day lags and have a 20% setback. You know what? If you're long on that, you won't survive very long. So this, you can see the other cycles, and this rally from the 09 low is already way on to borrowed time for the 4-year cycle. So it's possible that the 4-year cycle is completely overridden by QE. So at the moment you have to stay, if you want to catch the top, you stay long. But I'm warning that if I was an asset allocator, taking risk off the table. And the way I put it in my newsletter is anything not nailed down can go. I'd rather have the cash, even though cash doesn't give you a worthwhile return. I'll show you another one. This is France. France is not a Mickey Mouse economy. Not only is that a secular downtrend from the year 2000, talk about dead cat bounces. That thing, you know, it's underwater. But there are plenty worse than this. So when we're talking about Western world stock markets, they clearly ended normal in the year 2000, and are now in a secular downtrend. And as the world economy is moving from the old normal into a new normal. Now we're not in the new normal yet, but I've been saying all along that the new normal is a world dominated by Asia, initially China, and then India. And there are several things that go to this. You may well have heard of a report called the BRIC Report, written by Jim O'Neill and his team of Goldman Sachs. He wrote it 12 years ago, but at the time many people thought, oh, that will never happen. And actually all of the forecasts he made in that prediction have not only come true to date, they're well ahead of the schedule that he originally forecast. It looks as though the Chinese economy will indeed be the biggest economy on the planet by the end of this decade. Or if it's later, it won't be very much later. And then roughly 10 years after that, it will be overtaken by China. And the reason for the overtake is demographics. There are actually ethnically more Indians than Chinese at the moment. And that number is going to carry on getting bigger because the birth rate in India and Pakistan and Bangladesh is still very high, whereas it's not. In China, the population growth has already peaked because of their political policy, one child only. They have an aging, shrinking population. So when the energy of the current generations of China run out of steam, they will definitely have they won't fall back very far, but they will be overtaken by the more dynamic Indian culture. Incidentally, there's nothing new in this story, I'm saying. The peak of American total dominance of the planet was 1955 under President Eisenhower. And back then, 32% of the entire world economy was American. China was so minute you couldn't even measure it. The same applied to India. Now China already is number 2, and in plenty of industries, like its motor car industry, is 50% bigger than America already. It's just blown right by. And why, with 5 to 6 times more people, wouldn't it be bigger? I don't think you could get the genie back into the bottle. But incidentally, in my days at HSBC, I have actually done presentations to people like Deng Xiaoping, and he was the man who let the genie out of the bottle. He was accused of being capitalist but calling it communism. And his answer was, I don't care what colour the cat is, as long as it catches the mice. I don't think you could get the growth back in. Anyone that thinks the Chinese won't be able to consume, they're just an export machine, go to Shanghai or Beijing and you'll get a reality attack. You'll see that they can really consume like crazy. And incidentally, there's always been a saying in China, the emperor is far away, and so we can do what we like. And they don't want to be found out by the emperor. Consumption in China is massively understated. Most people run their personal car on the business. So the expenditure on that car counts as business investment, not personal consumption. In your world and mine, it's consumption. You see more Mercedes on the streets there than you see in Frankfurt, for God's sake. So they know how to consume. I don't think there's any doubt that they will pick up. Their economy, when it has slowed down to about 7%. Whereas America, when it heats up between 2.5%, that's terribly, terribly good. I get a kick out of reading the newspaper, you know, American economy booming. At 2, that's brilliant. Whereas China, only 7, that's pathetic, that's disastrous, set it short. And we come to India, only growing at 5.5%. Oh, what a catastrophe. You know, run that by me again. Yeah. We're living in a world that's going to be dominated by Asian markets. I don't think anything can stop that, but we're not there yet. The renminbi isn't about to take over from the dollar as the world's greatest currency. It will eventually, but they're not ready for that yet. And the rupee is nowhere near ready for it. So it's down there in the future. I tell my sons, your pension plan's going to have equities in it. You'll be some Indian equities. You'll be long the rupee, but not now. So anyway, we move on to another one of these Western markets. Yeah, this is the DAX. This is the best Western market in my opinion. That is nearer a new all-time high breakout, confirmed. It certainly hasn't died yet, but we do live in a highly correlated world now. 20 years ago, I used to do correlation statistics between world markets and indeed stocks in a market. And you could switch from the interest-sensitive stocks into the consumer stocks and make money as the economic cycle went round, or you could switch from one country to another and hedge your risk. Those things that weren't correlated are correlated now. And we live in a totally joined-up world. Most of those sorts of things aren't really working. And the funds that used to rely on some of these old correlations, like Mann, Adam Harding and Lewis, haven't been making money recently. So again, this is what I mentioned, you need 5 or 6 little models and you switch between them. Some of the older models in this new interim period aren't working. I think they'll start working again when we get to the new normal, but just now they're not working. The Swiss market was worth mentioning, and why I put it in was because you could see in the middle high there, it was a new high. And if you got excited and thought, new high breakout, go along, it's always a buy signal. You know, was it a false breakout? It lasted long enough for it to look like a proper breakout. It didn't make you a lot of money, it brought you the whole way back down. Another reason for mentioning it, though, is I think we can probably make a list of about 200 super-duper world-class equity stocks, and Nestle, which is in this market, would be one of them. These companies are bigger than many countries in their own right, and they're so international they can almost pick and choose where they want to pay any tax, if at all any tax, and they pay dividends, and dividends on this class of equities are an awful lot better than junk US Treasury bond or even a British gilt, you know, which used to be the safest asset classes on the planet, but QE is now so mispriced and they're toxic waste. You can go bust very quickly owning what used to be the safest asset class. So although you will probably be whipsawed to death, owning this type of equity, especially if the yield is above 3.6, anywhere between 3.6 and 5, you can find several of these giant equities like Nestle that would, for pension plans, is a good place to survive. This is the USA. Now again, that although the S&P stretched a bit, that is still technically a broadening top. And you can see it's overbought. We've just recently had a classic case of you buy on the rumor and you sell on the news. On the rumor that there might be going to have some sort of agreement, the market rallied, and now we've got it, it falls back down. And incidentally, I don't know if you've seen the chart of the dollar trade weighted recently. It's right on the edge of the cliff. If it drops one more little bit, it's going to be a great short. In fact, anyone who's long dollar right now, I would seriously curtail the position and I'd do it soon. Classic case when people panicked out of emerging markets. The no-brain trade was to go long US dollars. It's got to be the safe thing to do. And a lot of people did it. And you know, the golden rule is when everybody seems to be thinking the same thing, it means nobody's thinking at all. A no-brainer means you haven't got a brain or you weren't prepared to use it. And the long dollar trade was a losing trade. It had to unwind. And just more recently, people who went long, they're losing on it right now. The Chinese, who own more dollars than any American, are making it abundantly clear We don't want any more of your rubbish piece of paper, the way you'll keep printing 85 billion a year, a month of it. We're not going to take it. We're absolutely as far as we're going to go. If we buy oil and gas from Russia, we're going to deal in rubles. We buy stuff from South Africa, we'll sell it in rand. We're not going to go through your currency. We've come to the end of that. This isn't the end of the dollar, because once upon a time it was sterling. Everything went through sterling for old historical reasons. We're still here. We still have a pound. It's still quite an important currency. So out in the future, incidentally, 25 years from now, the American economy, although it will be a bigger economy than it is now, it's likely to be about 9% of the world, down from 30. It's 20 at the moment, down from 32. It'll get to 9. And India and China look as though they'll settle down at about 18% each. That's looking into the future by the time your pension plan is due to pay off full. That's the world we're moving. That's the new normal. So this, I'm expecting the normal cyclical pullback. If the cycles aren't completely overridden and work, it should be quite a nasty, short, sharp, rather violent setback, bringing the PE ratios down to something where Warren Buffett will say it's cheap, or Benjamin Graham, whatever fundamentals will identify them as being cheap. They're not cheap at the moment. The Russell's on about 26 times earnings, and even on what they call forward earnings, the S&P's on 16.5. Benjamin Graham says you buy on 7 or 8, you sell on 15. So fundamentals would take you out of the market too. And I personally think this is a setup for the nasty setback. Then, if we do get the setback, 14, 15 and 16 could be a bull market. But in virtually all Western markets, it still won't take out the 2000 high. So whether it does in America or not depends on a lot of things, like how big this setback is. But the US economy is not doing well. It's just, this has been the weakest economic recovery in living memory. And that's in spite of receiving $3.6 trillion worth of pump money. It's a catastrophe, really. Incidentally, on unemployment, they have numbers they call U1, U2, and they go up to U6. When they read in the papers unemployment, normally U3 is the one they quote. This is very excitingly come down from 7.4 to 7.3. You're supposed to be terribly pleased about that. Well, U6 is 14%. And if you want to know what the real numbers is, go onto a website called shadowstats.com. The real number is 23%. So in other words, Detroit's not the only bankrupt city in America. That looks like the Depression of the 30s, doesn't it? That's what the cycles are saying. We are living through what last time was the equivalent of the 1930s Depression. People used to queue in the streets to get soup off a wheelbarrow. Now they get a check in the post, but it's the same deal. And General Motors went bust already. Detroit's bust. The two major Californian cities, not San Francisco, one of them that are technically bankrupt now. And it's terribly difficult when you go around the streets of either Manhattan or San Fran to work out, what's wrong with the world. But then throughout the 23-year bear market in Japan, if you went to Japan, it was one of the loveliest, most prosperous cities, and you have a meal in the Ginza, it's outrageously expensive, and the restaurant's full. So it was very impossible to tell with what you might call anecdotal evidence what the economy was actually doing. You have to look at just the numbers. But anyway, this is still a broadening top to me. We haven't broken that fan pattern. I don't think we're going to. That we either get, to please me, a crash pretty damn soon, this side of Christmas anyway. If we carry on into the new year, we might get up as far as May and then come down with an even nastier bump than I'm saying, basically. This is Russia. Well, notice what happened. That wasn't the year 2000. Russia is one of those markets that's way, way higher than it was in the year 2000, but that was a bubble. And bubbles have to burst, and they nearly always come down to lower than they were before they burst. And really what we're looking at in the case of Russia is an oil and gas play. We'd be just as well off trading the price of oil and gas as the Russian index. This is India. It's hundreds of percent higher than it was in the year 2000. All Western markets are lower than they were in the year 2000. This is hundreds of percent higher. It did indeed get very high. Golden rule, there is a single top, a double top, and a triple top. There is no such thing as a quadruple top. If it even attempts for the fourth time, you can bet your life on it, it's going through. And in my opinion, it's just in local currency terms, when the Sensex or Nifty index go through, actually probably not just yet, but the long-term secular trend in India is fine. It's also one of those classic cases why when you come out of one currency like the pound and go into a foreign market, you do need to take a separate decision about the currency. So what you should do in many of these markets is you go long the market but short the currency. I would say that because Echo, that's exactly what we do. We manage this sort of transaction in currencies. But the long-term secular story for India is good. It may pull back a little bit because it's still a bit expensive, but very few bits of foreign money are in it. They flooded out, and the market's still held pretty well. When the foreigners want to come back into this, their buying alone will be what cracks it through. But you'll be short the rupee for the time being. Probably quite a long time. It'll be many years before the rupee becomes a major currency. Yeah, here we are. Oh, this is the China composite. The purpose of showing this is, it is indeed completely different. That enormous spike was the Beijing Olympic Games. Remember I told you a bear market always has to have a fall, followed by a rally, followed by the rest of the fall. So you can see that from the Beijing Olympic Games, which was a bubble peak of outrageous excess valuation, we've got a very mature, developed bear market in place. It might have bottomed, but you can't put your hand on your heart and say for sure it has bottomed. It's cheap now. The latest figures coming out of China are, you know, you were panicking. It's not going to grow at less than 7.5%. By the way, car sales are up 15%. You know, the story that China's not going to make it is bullshit. You're looking to put on long trades on this market. Now, I would only deal in an ETF on the index. We're not going to go and buy individual stocks there. I think to actually make the money from inside China, you need to be Chinese or have local partners. But we can trade an ETF on the index. And the Shenzhen index is another one you can trade, which actually has a much stronger looking chart than this. I'm showing this because it's the weaker of the two. Mexico is quite clearly a secular uptrend. It does indeed have very violent setbacks, but it's hundreds of % higher than it was in the year 2000, unlike Western markets. So it's part of that thing. It's below the 200-day moving average now, so it's in a pullback, if you want to call it bear market phase. It actually rallied back to the 200, topped on it, it's coming down, and the slope of the 200 has bottomed right, has flattened right out. So you're still going to get a pullback here. But the longer term trend, what you might call the ruler line, if you connect those major lows, that the secular trend is still absolutely strongly positive. This is South Africa, it's another one. I got trapped in my yacht for 3 months in South Africa. It's, for as long, HSBC used to send me to South Africa about 4 times a year, and all of that time, over 20, it was always been in a secular uptrend. Most Westerners are terrified of buying it. They're full of, they're going to have bloodshed, and you know, this is before Mandela, they never did. They don't like the Zulu man now, but the fact is, the secular trend is awesomely strong. And you can't beat it, but what you do if you're coming into sterling is you sell the rand. You must cover the currency, otherwise the currency can lose you more than the market can make you. But I don't see this coming to an end. When I was sailing across the Indian Ocean, there's a thing called AIS, which electronically identifies ships that are out there and might hit you. And you can put the little cursor onto the cross on the screen and it opens it up. It's 400 meters long and 80 meters wide. It's coming your way at 22 knots. And it will be within 1 mile of you, and it gives you a time. And if it ever came to less than 1 mile, I would alter course to get out of that bloody way, because these things are huge. They all had Chinese names. They were all laid, and they're all going from South Africa to China. So China is making these guys rich because it wants to buy what they are selling, and that's not going to stop. You know, the population of China is not going to suddenly stop eating or making things just because the world economy is a bit flatter than it used to be. Incidentally, my work is not gloomy on the growth of the world economy. I hope I haven't given you that impression. what I'm saying is the emphasis in the economy switches from being Western US-led to being Asian-led. And different industries, the things that Asia likes, will become more important than the things the West likes. Now this is the Japanese market. I actually lived in Japan back in the 80s on the way up. And I came back when it peaked. And I love going to Japan and have many friends there. The Nippon Technoanalyst Association is a very, very good chartered society. According to me, the secular downtrend that began from just under 40,000 bottomed in 2003. What we've been making since then is a giant base, and we've now come out of the secular downtrend. We're now in a new secular uptrend, but this huge spike up, which is the first move in a new bull market, went too far too fast. And you can see we've had a fall, a rally, and we're having the rest of the fall, but still above a steeply rising longer term trend. I think the fallback can come back a little bit more, but it's basically in a bull market now. So we are seeing a pullback in a good bull market. It's one of the few really big markets which has lived through what we might have to live through. If you think about it, we're only 12 years into something it took Japan 23 years to do. That may well be the model for the Western world. They've gone through this. Incidentally, the fact that Japan has an aging, shrinking population is already fully discounted. And another way of Abenomics looks like it's got more than half a chance of actually working. He's lucky enough to be Prime Minister at the right time, whereas predecessors were Prime Minister at the wrong time. So I would be looking for a pullback, but I would want to go long, and in a global portfolio I would increase exposure on weakness to Japan. And it's also one of the very, very few markets where the banks look rather good. At the top of their bubble were 19 giant banks. I think there are 4 big ones now, because they all went through mergers and that sort of thing they had to. And the Western world's got to go through pretty much the same sort of thing before they're out of this. And so anyway, although the government owes a lot of money in Japan, it only owes it to the world's greatest saver, who is called Mrs. Watanabe. I've met her on many occasions. She likes whiskey, Mizuwari as it's called, whiskey and water. Though I think the low is in here, and on the pullback, I think it's we've had the first leg of a new bull market. And another very interesting thing is one of his arrows is to get the yen down. He wants the yen to be weak. And when indeed the market, global investors panicked out of emerging markets, everyone thought the yen would be weak. The yen was strong then, because this shows you the global investors are doing everything they can to not end up owning too many dollars. They'd rather own euro, yen and sterling than have even more dollars than they've got. That you can start to see this affecting the charts. This on the right, that's a secular trend is the yield, of course, on the 30-year bonds. So it's a bull market in bonds. I've always called it Bill Gross's bull market, Bill Gross at PIMCO. Even he didn't read it right the whole way down, but he made a hell of a lot of money on it. The question is that a double bottom, a spiky bottom and a more recent low? And the answer is, it looks as though Bill Gross's bull market is over. The reason why we have to say that is, if we were to go lower than that low, which is a yield of 1.6, the only way that could happen is that the world is in a global depression, not just bits of it, but the whole lot of it. And I'm afraid that is a possibility. It's a very scary possibility, not just the Fed. Every central bank on the planet will be doing everything in its power to prevent that actually happening. And I have enough confidence in human ingenuity to say they might go to the brink and look at it. The Americans have proved they can be dumb enough to do that. But in the end, they won't actually jump off the cliff. They will get it together. In which case, if you can imagine 2 parallel lines bracketing that, I've shown you regression lines, but if you put them in, if we were to break the top parallel line, which we have not done yet, then you would say we've ended the era of deflation, we're now into an era of inflation. Of course, when you've borrowed a lot of money from somebody, the first thing you want to do is to devalue the money before you pay it back. That's what you do. Undoubtedly, that's what America's going to try and get away with. And the people that own those dollars don't want to be the fall guy. But at the moment, we have not broken out of the top parallel on that trend. So although it's very much, we've got a possible bottom to the trend, but we haven't broken out of it on the upside yet. What we've just about had, though, is the maximum rally possible within those parallels before we break them. There's somebody who is only semi-technical, you might want to read, called Ray Dalio of Bridgewater Securities. I personally think he's every bit as well worth reading as Bill Gross is on PIMCO. Brilliant. He's a macroman, not specifically a bond man. He will explain this. He's quite negative on the debt mountain and how you pay that back. They will indeed need to drop back down here. And so if this thing had gone any further than just about 3%, the markets were revealing you're going to crack the economy. This very marginal little recovery we've got going, we can't sustain it. It'll come right back down again. And there's one other thing which is unintended, was poor old Obamacare. There were lots of people who had full-time jobs, and when their bosses thought, I've got to pay the insurance on these people, what I do is I fire them and give them part-time jobs. Then they pay their own damned insurance. So although Obamacare was designed to give poor people good health care, it's ended up getting quite a lot on fire. The law of unintended consequences. This happens, I'm afraid. I'll skip over the 10-year because it's the same story, and the euro is the same story. This is another one. I am personally, right now, long gold. Not gold mining shares, but long gold. The secular trend here, that although we clearly broke what was quite a long-term trend, I think this low, if you want to put a ruler on the lowest low and that more recent big low, I think and there's a big moving average coming up there, I think you'll find that line will hold. And what it's all about is if you change fiat currencies into valueless paper, you have to hedge it with real money. And there's only one thing on the planet that's been real money for thousands of years. All fiat currencies, from Roman denarios onwards, have gone valueless. I saw a very good chart recently of all European currencies from 1400 onwards, beginning with Spain, Portugal, Netherlands, France, Britain, and now America as the superpowers. You're allowed a 200-year window, and then your money turns to junk. We're just about out of time on that, on the dollar, and we're now moving into a period when India and China are going to be more important. And what do they love? They love gold. Incidentally, the festival of Diwali is the 2nd of November, and on the run-up to that, Indian women buy themselves a lot of stuff. I know my girlfriend is Indian, and after that, the wedding season, they buy even more stuff. So I think at the margin you will see the Diwali buying take place in gold. In any event, most of the physical metal has already gone to Asia. It isn't in the Western bank vaults anymore. So I will be, of course, my stop loss is if that low goes, I'm going to cut it. But I'd rather not lose money than be that wrong. But I am actually in gold right now. And I can be quite patient. I've been in most of that uptrend from really very low levels indeed. Probably bought my boat for me. The DXY is right now, this chart's slightly out of date. It's breaking those lows, or at least it was as I was leaving the office. It could come straight down to 72 if it's not careful. It needs to rally tomorrow or it's going to be a short sale. Now, all those guys that were long are cutting like crazy right now. Even the euro, for all people read about Greece this and Portugal that, and poor old Spain, but global investors have got the euro above its 200-day moving average. They're not that worried about it. So, I mean, we read the papers. We expect Angela Merkel to get some sort of coalition together and then decide whether she's going to give even more money to Greece or not. But the market is saying there's a flow of money into other big currencies than the dollar. And the reason for that flow isn't going to go away because Yellen is not going to start printing dollars. That's what people are running away from. There's a final point on this is the Japanese yen. Of course, going this way is if you like, Mr. Abe wants it to go this way. He wants to engineer a relatively weak yen to get his economy picking up. After that, the exporters alone will earn their way back down again. But just for now, it's part of Abenomics to keep this trend going. I haven't got a chart of sterling, but most things you buy, it's an absolute trend. A currency, a stock, or a bond is an absolute price. But in currencies, they're all ratios. So you don't need to be good to look good. You only have to be less bad than them. And just at the moment, sterling is less bad than really quite a lot of things. And so as investors coming out of sterling, you need to be very careful what else you go into. You'll almost certainly prefer to cover the currency risk as a separate exposure and not take that risk. You can have a very good thing to buy in another country, but don't want the currency risk. So get rid of it before you put the position. I've gone on rather a long time, but
not at all.
If there are any questions, I'm happy to try and answer.
Any questions?
Hi. You talk about growth for China and India in the future, and how China will be obviously the world's largest
first.
economy.
Yeah.
Have you factored in the prospect of maybe a war breaking out?
That's a very good point. History shows that the wars are fought by the two fastest growing economies at the time. Right? Thank God at the time we had two of them. The British economy was just bigger than Germany. The first time we were quite a lot bigger, the second time just bigger. So down the road, as a historian, you would probably see a conflict fighting over global resources, 2.5 billion people each, China and India, they will be in conflict. So that's a good, it's a scenario which history says will probably happen at some point.
Okay, and my second question is, you said economics has more than a 50% chance of working, or something along those lines.
Sorry?
Abenomics?
Abenomics, yes, yeah.
You said it has more than...
I think, it's got a good chance because he's doing it at a time when the market's already had an enormous fall. It's wiped out the overvaluations, got things down. A lot of rationalization has gone on. And there's, we were coming off a low base. Was when doing it on the way down, it was inherently unlikely to work. And in any event, they did some of the wrong things. Even he's had to make one mistake. Just as soon as he tries to simulate taxes has to go up a bit. But I think he's probably right that that's something he inherited, something he had to just do.
Okay, but the problem with Japan has always been their aging population.
Yeah, that's now in the price.
And the fact that they've never had the integration
Absolutely.
to the economy.
They hate the gaijin. Well,
So,
they don't want them anyway.
Without those factors changing,
they're still incredibly wealthy, high-tech nation, and they're well placed in Asia to be, not to be the number one, but to provide really high-tech products with and money and know-how and all of that. In a way, a role that some British companies, when they faded, eventually did exactly that sort of thing. And I'm sure there'll be some American companies who do, but Japan is very well placed to benefit from exactly that.
With regards to technical analysis in some of the bigger buy side and the sell side firms, how would you see they working differently? Firstly, with buy versus sell, and then within, say, buy side, the top 3-4, and in the sell side, the top 3-4. How do they use that along with fundamental analysis?
Well, it's changed because when I started off in America, Bob Farrell was at Merrill Lynch, Alan Shaw at what's become Citi was Smith Barney in those days, and dozens of technicians were trained by one or other of them. And there were more of them then than there are now. Neither of those companies have equivalent people. So, unfortunately, in what I noticed though when I went to Japan back then, it was the buy side that had lots of technicians. Of course, Nomura had them too, but the buy side had more technicians than the sell. Whereas in the West, it was the sell side that had. The chartist was, like me, was to get you to give our guys an order and pay. And we had commission in those days. We didn't have basis points. We had 1.25%. It was a business. It's gone. I'm afraid that's history now.
I think you're quite bearish on the dollar, as I've seen. Against what would you actually...
I think the DXY looks like it's on the verge of pulling back to 72. It may, as it were, pull the trigger today. It hadn't quite when I left the office, but It's not going to disappear. It's still going to. It still is the big currency for a few more years. But I think it's coming back to 72. That's what the chart is suggesting to me. And then you'll have to unwind. You'll get a flow that unwinds that trade too. Because just as you're getting panic, people who are betting the wrong way, they're now having to unwind it. And some are going the other way.
So would you go short against what, the sterling, euro?
Well, cable would be one of the rates, and the euro. The bigger trade is the euro, of course. But being British, I feel more comfortable. I genuinely think that the British economy is, as bad as it is, relatively well off, and the pound is relatively understandable. Whereas lots of weird stuff could happen in the euro. I mean, do we know what Angela's coalition's going to look like? And will she, won't she hold the euro together? There's a lot of people saying, and have always said, the euro is unsustainable. And I hear talk about a sort of two-tier euro. You'll have the Mediterranean countries in a soft euro which isn't available for international trade, and only Northern Europe has the hard euro. And the rand went through a period like that years ago. You can have a block rand and whatever. So I put it this way, loss of face being as important as it is, they will try every half-baked scheme before saying we've got to give up on this. I don't think Merkel's on the verge of giving up on the euro yet, even though lots of you are arguing eventually it's got to die, as it is. It can't be sustained.
So you're more comfortable on the
I'm
sterling?
more confident on the cable. I would be long sterling. Yeah.
And short of the yen then?
Yeah.
Ask a quick question as to how you build your positions. Just going back to the subject of entries, you did mention that entries are perfectly random and stuff like that. But for example, taking your gold position, the one which you built up.
Yeah.
So do you sort of put in a very small initial position and then scale in?
For PA trading, I think never forecast and be incremental at all times. So let's say we've got something that looks like it's bottomed. It's had a fully fledged bear market. The fundamental guy says it's cheap. I want to own some. I need at least the pattern on the chart to go to rising highs and lows, and maybe becoming off a very oversold position but starting to unwind that. The maximum I would put on would be 1% of the equity. And then when I get, let's say, a golden cross of that moving average with a slightly longer one, I'd put another 1% on and accumulate a position. So pyramiding up, your later positions capture less of the move, but with greater confidence. Incidentally, there's all of these other indicators that are derived of the first or second derivative of price don't actually hold any more information than the price itself. But what they do is give you greater confidence that you are indeed building the right trade. So for no other reason than to build your rather shaky confidence, I know I'd like to do that. But I don't enter the trade on the indicators usually. It has to be rising highs and lows. And for longer term investment, if we're not above the cloud or at least above the 200-day moving average, it's not a bull market, so I'm not going to go long.
Given your technical analysis, I was quite surprised that your argument has been on gold seems to be based purely on fundamentals. So
I think that we've had the full rally, rest of fall. If that wasn't a capitulation phase, what the hell was it in gold? I mean, most of the things are technically there as well.
I mean, you spoke at the beginning about connection motions.
Yeah. Yes, it hasn't given that signal yet, but I'm in this thing from way down. So I'm building a position that builds hundreds of percent from here, and I've traded out of it on 3 occasions. I didn't actually come out at 1900 because I was around the world on a yacht. It's quite difficult to do that, but I'm back in again right now, building a position that I've had all that way up, basically.
Do you have a target?
I think not this year, but it will take out 1900. 24 is my next target. 3.6 the one after that. 5 the one after that. And somewhere between then and 10, I may eventually buy a new yacht. Yeah.
What do you think is the catalyst that will trigger the pullback that you are talking about?
In markets,
Yeah.
we nearly had an event there. In a sense, the market will latch on to something that it wants to use as a trigger. But the market's already right. If you look at some of the really large asset managers, they have been distributing money back out to what they call the mug punters already. Let the mug punters belong to Tesla, and we're dumping out Walmart, IBM. We're just getting out of them. They've got the money, so that when they're going to be the buyers, it's put the low in when the thing panics out. All of the signs are basically there. We just haven't got the crack yet. It could be, an Al-Qaeda type event. The market will latch on to something and say that was the reason. I remember back in '87, or even at 9/11, the market had all sorts of reasons, but actually it was doing it anyway. We were already in a bear before the 9/11 thing happened, and then that was the reason. With hindsight, it wasn't really the reason.
How will you change your timing of this crash between, let's say, you said end of October, November, or May, basically?
If it weren't for QE, I think we're in the month that it would have the setback, but it might go on into November. But there is QE, so I accept that, which is designed to stop exactly this happening. They've been trying and succeeding in overriding markets, but what they haven't succeeded in doing is getting the economy going. It really isn't good, and it's not going to get better. When you read Ray Dalio, there are several. If they were written the end of world type scenarios by anyone with lesser people than Dalio and Bill Gross, you don't think the man's nuts. But these are the guys writing it. These are billionaires who have to get things right. But in any event, that's what the cycles say. The cycles have always said, ever since the year 2000, we're rolling into what was the last time around, the depression of the 30s. And when the history books tell you Roosevelt tried this, that, and the other thing, none of them worked. It was World War II that worked to get the economy going again, making a few bullets. But we don't want World War III to come out of this thing. But most of the jobs that America used to have, or indeed Britain used to have, we don't have them anymore. We don't make the steel anymore. There's no steel in Pittsburgh. It doesn't happen. They do make cars in America. They're called BMWs and Toyotas, but the world has moved on from the things America used to be really good at. I'll tell you one that really shook me. I've got an iPad and an iPhone. I live with it. I'm trotting around feeling I've got the latest big thing. 3 months is all it took Samsung to blow them out of the water. How did that happen? This is the world we're living in. You better look to Asia. Those guys are good. They're going to win. Yeah.
So you gave a very good explanation with regards to the top-down approach, with regards to the different countries.
Yes.
Can you spend a minute or two just sharing your thoughts sector-wise? Which are the sectors which you think are going to be bullish or bearish?
Yes. I'll tell you what we would normally do, and you can get there's a guy who's dead now. Ian Notley's work, the Yelton Fiscal, a guy called Jonathan Arter still runs that, and Pring's work. I would do exactly the same thing. I always used to do it, but at the moment it isn't working. What used to happen is at the start of the economic cycle, interest rate sensitive stocks would perform well. Then they would become a bit too expensive, and then the consumer stocks would pick up. And then at the end of the cycle, the machine tools and the heavy stuff would go, and then you'd buy bonds to survive the bear market. That used to be the normal rotation, and the Pring and the Notley systems are very good at picking that up. There's also Julius de Campana has got an excellent thing on Bloomberg with brilliant charts of sector rotations. And what's happened is they normally rotate around the center, but QE's moved the whole, they rotate over there. So it's sort of working, but not working anymore.
So you're saying it is actually connected in a way that it is not connected.
QE has been designed to break this.
Okay.
They want you to buy risky assets and not safe ones, so they misprice the safe ones. When that all stops, the Pring thing will start working brilliantly again. Absolutely. So, and it'll work in these other markets too, I'm sure of it.
Any other questions? When you said you're expecting cash sometime this month or before Christmas, do you expect that to coincide to overall what you said about how late October is usually a good time to buy?
Well, it's only a good time to buy because you get the fall to it. If we don't get the fall, it isn't a good time to buy.
So that means that's the same fall.
Yeah, you've got to wind the spring. The cycles argue we should be falling, the fundamentals argue we should be falling. If QE stops it, we're in this weird thing. It's expensive, but the money is holding up certain things which are holding the index up. And my reaction, the very good answer is in Nicholas Taleb's latest book, because after all, QE is a sort of black swan, isn't it? His strategy is what he calls a barbell. At one end of the barbell, you have the safest, lowest risk asset you can have, cash. And at the other end, you have a few, like insurance premiums, very highly volatile options. If they expire valueless, they do, but if one of those options pays off, your whole barbell goes up. But all you can lose is the value of those options. You precisely define what you can. I think that strategy for right now is a very good way to do it. But in my own portfolio, I'm massively liquid. It was so liquid, one of the reasons I did buy some gold, because to me that's still money.
And with that, I would like to finish off. But before we finish and thank Robin for his really, really brilliant and wonderful presentation. One brief announcement. Our next chapter meeting, taking place on the 9th of November, will actually be a special event. We've been asked to give a presentation at the London Money Show. So we'll actually have on the 9th of November on Saturday 3 events. The first one will involve me. I have a presentation at 1:30 called Path to Professional Trading from Ambition to Action Plan, which will focus on on people that would like to become professional traders, what are the problems and hurdles that they have to go through. The second event we have is actually a panel discussion on how to combine technicals and fundamentals. There you'll get a chance to speak to hear Robin again, because he will be part of the panel discussion. Robin, as along with Ralph Akamporak, one of the founders of the Market Technicians Association. We have Greg Johnson, Rushmold from Shares Magazine, and we have a leading analyst from Elliott Wave International. And right after that, we'll also have our regular chapter meeting. So the 9th of November at the Money Show will be a day full of events. And with that, we'd like to thank Robin for his brilliant presentation.